What you're about to hear isn't shocking, it's familiar, and that familiarity is the risk. Every financial crisis leaves behind the same lesson, and every generation convinces itself this time is different. The warnings were clear long before the outcome, yet they were dismissed because they didn't feel urgent until urgency was unavoidable. This isn't a forecast, it's not a theory, it's not designed to provoke panic or sell certainty. What you're seeing is a system behaving exactly the way it always does when it's stretched beyond what it can sustain. Markets don't collapse on impact, they unravel in layers. Confidence fades, liquidity thins, and then reality accelerates. Right now, we're in the final window where awareness still exists. Because once the market opens, reaction replaces reflection. What if that moment has already arrived? Black Monday isn't a nickname invented by social media. It's a scar left on the timeline of financial history. A label reserved for moments when leverage collapses all at once and the system realizes it has been lying to itself. In October 1987, markets didn't slide. They vanished. Liquidity evaporated in hours because fear traveled faster than logic ever could. Computers amplified panic. Sellers rushed for the exits, and there was no one left to take the other side. That day proved something uncomfortable. Markets don't crash randomly. They break exactly where the pressure has been building the longest. Every Black Monday looks different on the surface. Different assets, different excuses, but underneath, the same mechanics are at work. And this time, the pressure is far greater. Last week was not the event. It was the warning shot. Silver surged toward $75, and trading was abruptly halted. To many, it looked like chaos. To anyone who has watched these cycles before, it looked familiar. When markets hit the brakes, that suddenly, it isn't because the danger has passed. It's because the system needs time to breathe. Halts don't fix imbalances. They don't create supply. They don't remove leverage. They simply freeze the screen long enough to keep panic from spreading too fast. The problem doesn't disappear. It waits. What we saw wasn't collapse. It was the tremor you feel just before the ground shifts beneath your feet. The moment when the system flinches, revealing where it's weakest. Tremors don't destroy cities, earthquakes do. There's a reason this keeps happening. And it's not greed or conspiracy, it's addiction. The modern financial system runs on leverage the way a fragile bridge carries borrowed weight. Every year, more load is added, more promises, more IOUs stacked on top of the same narrow supports. As long as nothing moves, it feels stable. But stability built on borrowed strength is an illusion. Leverage doesn't disappear when markets wobble. It compounds. When losses appear, institutions don't step back, they lean forward. They double down, hoping time will solve what math already has. That works, until it doesn't. Because when a bridge is already cracking, adding more weight doesn't buy safety. It guarantees failure. And once leverage turns from tool to trap, escape becomes impossible. What happens when the bridge is already cracking? There's a reason the most dangerous moves don't happen during daylight hours. When Asian markets open, the world is thin. Fewer participants, less liquidity, narrow order books. That's when prices don't walk, they jump. Overnight sessions aren't guided by balance or debate. They're driven by urgency, by whoever is awake, whoever acts first, and whoever cannot wait until morning. This is why global repricing events often begin while the rest of the world is asleep. There's no time to negotiate, no gradual adjustment, just gaps, sudden jumps from one reality to another. By the time Western markets wake up, the damage is already done. Screens don't ask permission, they update. While you sleep, prices decide your future. When silver jumped toward 75, it wasn't just moving higher, it was sending a message. A gap up isn't a vote of confidence, it's a confession. It says sellers didn't slowly change their minds, they vanished. The offers that once filled the book were pulled, leaving nothing but air between price levels. Buyers didn't push the market up, they chased it. This is what happens when supply steps aside and demand keeps walking forward. Each trade lifts the next one higher because there's nothing in the way, no resistance, no negotiation. Just price discovery trying to find reality in an empty room. Gap ups don't ask whether a move is reasonable. They reveal that reason has already left. What if there's no one left to sell? At the center of this sits a name everyone knows, not because it wants attention, but because it's too large to stay invisible. JP Morgan isn't a villain in this story. It's a pillar. A systemically important institution woven so deeply into global markets that every move it makes sends ripples outward. And that's the problem. Size brings power, but it also removes agility. Small players can exit quietly, giants cannot. When positions grow this large, selling isn't an option, it's a signal. Every attempt to reduce exposure moves the market against you. In 2008, the bank survived the collapse of Bear Stearns, but survival came at a price paid by the entire system. The lesson was clear then, and it hasn't changed. Too big to fail also means too big to escape. Most people think silver is silver. A price is a price. A contract is a contract. That assumption only holds as long as nobody asks for delivery. Paper silver is a promise. Physical silver is a thing. And the entire system runs on the idea that not everyone will ask for the thing at the same time. It's like selling warehouse receipts for boxes that may or may not still be on the shelves. As long as the receipts trade hands, nobody checks the inventory. But claims grow faster than stockpiles. Promises multiply because they're easy to create. Metal doesn't. It has to be mined, refined, shipped, stored. When confidence is high, that mismatch stays invisible. When confidence breaks, it's exposed instantly. And when too many people reach for the same door, only one question matters. What if the warehouse is empty? When pressure builds, the game doesn't stop. The rules change. Exchanges are designed to survive volatility, not eliminate it. When prices move too fast, trading is halted. Margins are raised. Requirements are rewritten in real time. On paper, these mechanisms exist to protect stability. In reality, they protect the structure itself. During past squeezes, rule changes didn't solve shortages. They delayed consequences. The COMEX has done this before not to restore balance, but to prevent delivery when delivery wasn't possible. Trust erodes quietly in these moments. Participants realize the system only functions when stress is low. Once the rules shift mid-game, every player understands something fundamental. Fairness is conditional. Rules protect the house, not the players. $75 isn't just a price, it's a line. Below it, silver is a niche trade, something ignored, debated, dismissed as too small to matter. Above it, the conversation changes. Attention sharpens. Headlines start forming. Fear slips into rooms that were calm just days before. Markets respond to psychology long before fundamentals catch up. Numbers become symbols, and symbols spread faster than data ever could. When silver pushed through that level, it stopped being an asset and started becoming a signal, a reminder that control may already be slipping. This is where disbelief cracks, where observers turn into participants, where people who never cared start asking the same question at the same time. At what price does disbelief turn into panic? Up to this point, most of the focus has been on traders, screens, charts, positions. But the real shift begins somewhere else. In factories, in supply rooms, in procurement meetings that don't care about price targets or technical levels. Manufacturers don't speculate. They don't wait for pullbacks. They secure inputs so their production lines don't go dark. For them, silver isn't a trade, it's a dependency. When access becomes uncertain, cost becomes secondary. This is what economists call inelastic demand, but the reality is simpler. You either get the material or you shut down. And shutdowns are not an option. Once industrial buyers wake up to scarcity, they don't nibble. They move directly, quietly at first. Then all at once. Factories don't hedge, they survive. There's a moment when institutions realize they're no longer early. They're not even on time. They're late. And late money doesn't arrive calmly. It rushes. Imagine a crowd discovering there's only one narrow exit and the lights are about to go out. No one cares about elegance. Everyone just wants through the door. That's what institutional buying looks like when urgency replaces strategy. We've seen this before. In 2022, the nickel market on the London Metal Exchange unraveled when physical delivery suddenly mattered more than paper positioning. Prices didn't climb, they leapt. The exchange froze, rewound trades, and trust fractured overnight. Not because of speculation, but because reality arrived faster than the system could process it. When big money panics, charts don't move in lines, they spike. Late money never moves gently. Behind every dramatic price move is something quieter and far more dangerous. Derivatives. Promises layered on promises. Contracts built on other contracts, all assuming the foundation beneath them will never shift. On their own, these instruments look manageable. Together, they form a web so dense that no one can see the full shape of it. Silver is not isolated inside that web. It's a strand, and when that strand tightens, tension doesn't stay contained. Losses here trigger margin calls there. Collateral is pulled from unrelated positions. Stress migrates silently from one market to the next. This is why small markets can cause large damage. not because of their size, but because of how tightly they're connected. Pull hard enough in one place, and the entire structure feels it. Pull one thread, the net tightens everywhere. Contagion doesn't begin with numbers. It begins with doubt. Banks don't operate on cash alone. They operate on confidence, the belief that tomorrow will look enough like today to keep everything moving. When that belief cracks, the machine stalls instantly. Not because assets vanish, but because trust does. In 2008, Lehman Brothers didn't collapse the moment its balance sheet failed. It collapsed the moment the market stopped believing its assurances. Phones stopped ringing. Counterparties stepped back. Liquidity froze in place. What followed wasn't a mathematical event. It was a psychological one. That's how contagion spreads. One institution hesitates. Another notices. Soon, everyone does. Doubt travels quietly at first, then all at once. It moves through balance sheets, headlines, and whispered conversations between desks that used to trade freely. When confidence drains away, markets don't debate fundamentals. They seek exits. Credit tightens. Risk models break. Overnight lending becomes a question instead of a certainty. Even healthy institutions begin to act defensive, not because they are insolvent, but because survival depends on speed. This is how stability unravels, not in explosions, but in pauses, in unanswered calls, in trades that don't clear, in promises that suddenly require proof. It happens quietly, then suddenly. By the time it is visible to the public, it has already reshaped behavior behind the scenes. Markets don't announce this shift, they reflect it. Once gone, rebuilding it takes years, not headlines. Confidence vanishes faster than cash, every single time, without warning. From here, the road splits, and none of the paths are comfortable. One outcome is a controlled squeeze. Prices rise, volatility is managed, and settlements happen just fast enough to avoid panic. This is the version policymakers hope for, the scenario drawn in briefing rooms and emergency meetings. Damage is contained, headlines are softened, and narratives can be written after the fact. It requires coordination, confidence, and time, three things that tend to disappear precisely when they're needed most. Another path is disorderly repricing. Gaps widen, halts multiply. Price discovery breaks down as buyers and sellers lose contact with each other. Liquidity thins, spreads explode, and screens begin to lag reality. The market doesn't technically fail, but it stops functioning in any familiar way. Fear fills the space where certainty used to live, and hesitation becomes the dominant force. The final option is forced settlement. When delivery isn't possible, paper positions are closed in cash. Contracts are honored in name, not in substance. The difference between owning an asset and owning a promise becomes painfully clear in a single moment. What looked equivalent on paper separates in reality. Each path leads to a different outcome, but none are clean, none are gentle, and none restore confidence overnight. The system moves forward, but it doesn't move back to how things were before. There is no reset button, no rewind, only forward motion through consequences already set in place now visible. Only one path avoids panic, and it's narrow. Most retail investors believe volatility is opportunity. They're told fast markets mean quick profits, that violent swings are where fortunes are made, that chaos favors the bold. They're told halts exist for safety, that pauses are there to protect everyone equally. What they don't realize is that volatility doesn't just move prices. It quietly decides who is allowed to participate and who is forced to watch. When trading is halted, prices don't stop forming. They never do. They simply continue forming somewhere else, behind closed doors. Algorithms keep repositioning. Institutions rebalance exposure. Risk managers make calls in real time. Liquidity finds private channels. Deals are negotiated off-screen, away from the blinking charts retail investors depend on. By the time the halt is lifted, the story has already advanced to the next chapter. The gap has already printed. The range has already shifted. What looks like a fresh opportunity is often just the aftermath of decisions you were never invited into. Retail traders reopen their screens and see a new price, disconnected from anything they could have acted on. This is where timing becomes everything, and timing is the one advantage small traders never truly have. You can be right on direction and still lose. You can read the macro picture perfectly and still miss the move, simply because you were locked out when the real decisions were made. Volatility doesn't democratize markets, it concentrates power. Halts don't level the playing field. They tilt it sharply and quietly away from you. Halts don't stop prices, they stop you. History is often loud about its disasters, but quiet about its survivors. Across every major financial reset, the pattern is the same. Those holding leveraged promises scramble. Those holding something tangible wait. Not because they're smarter, but because their position doesn't depend on permission. During the Weimar hyperinflation, paper wealth dissolved in real time. Savings accounts remained intact in numbers, yet collapsed in meaning. Physical assets didn't rise in value, currency fell around them. The winners in these moments rarely look heroic. They don't trade actively. They don't celebrate volatility. They simply endure while systems recalibrate around them. Speed feels powerful in a crisis, but it's usually a trap. Stability comes from placement, not motion. History doesn't reward speed, it rewards position. What happens next will feel sudden to those who haven't been watching. Years from now, analysts will replay this window frame by frame, pointing to the signs that were visible long before the reaction. They'll say the data was there, the pressure was obvious. The outcome? Inevitable. What they won't be able to recreate is this moment, the space between awareness and action. This is not a call to panic. Panic destroys clarity. This is a call to attention, to preparation over prediction. Markets don't announce their turning points in advance. They reveal them in hindsight. The opening bell doesn't mark the beginning of the event. It marks the end of the warning. Stay informed. Stay grounded. Watch closely. When the bell rings, it's already too late.